A rate cut is finally expected this week, but how low will the Fed go? Welcome to Market Insight. I'm Elena Casas. The Federal Reserve is set to embark on an easing cycle this week after more than a year of keeping borrowing costs at a 23-year high. The odds of a 50 basis point cut are now seen by traders at over 60%, although there is concern that a big cut could trigger a sell-off on fears the Fed now sees the economy cooling too fast. Well, for more, I'm joined now by Eric Sterner, CIO of Apollon Wealth Management. Eric, hi. I know you're expecting 25 basis points this week, not 50, but why?
Well, thanks for having me. And yeah, it's interesting just to really see those probabilities of a 50 basis point cut increase over the past few days. And I think there's just been some growth scares that have come and gone over the past few weeks. But historically speaking, the labor market is still very healthy. I think some folks are comparing it to when it was just red hot before and unemployment was in the low threes. Now unemployment is about 4.2, but a lot of that rise had more to do with more people entering the labor market as opposed to layoffs. Even looking at the JOLTS report from earlier this month, it was cooler than expected at 7.67 open jobs. That's higher than any JOLTS figure pre-pandemic. And even initial jobless claims are showing that we're in a low hiring, low firing labor market right now. And those claims right now are still 80% less than any point this century. So while yes, the labor market is cooling, it's just moderating. So I don't see it falling off the cliff. And I just don't think the Fed wants to repeat mistakes of the 70s where they let inflation reignite by moving too early.
A soft landing, though, is definitely not yet guaranteed. So do you think a smaller cut would put the Fed under pressure to show they would be willing to go faster if the slowdown gathers pace?
Yeah, I think that it'll be really interesting. Obviously, not only I'm looking forward to seeing whether it's 25 or 50, but the latest dot plot. And we know that the dot plot from back in June, they were projecting one rate cut and 4 next year. I anticipate them to up that to at least 2 this year, possibly even 3. I mean, they may go 25 for the next 3 months, or they may, they've talked about going every other meeting. So I think Fed, especially with the annual number of jobs that were added to the economy, there was that revision of loss of 800,000 jobs, or from the estimates with the year ended March. I think that spooked the markets. So to answer your question, I think that will be something Powell will have to address in the press conference, that if the labor market unemployment rate does get some more velocity, are they prepared to act? And I'm sure he'll answer yes to that question.
What's your longer-term forecast? Do you think investors should still be positioning for the chance of a possible recession?
I think in any given year, the odds of a recession are 15%. I would say it's definitely a bit more, maybe a 25%, because they are trying to walk a thin line there. Like you said, my base case is a soft landing because I think corporate earnings are in good shape. I think the consumer is still in pretty good shape. Even the Fed report last week showed that household wealth grew by 2.8 trillion last quarter. So yes, the lower end quintile consumer is feeling the pain. I mean, we're all feeling the pain to some degree because the cost of living has increased. I think the higher end consumers have generated a lot of wealth from the stock market, from housing prices skyrocketing. So there's a lot of home equity to tap into. However, from an investment perspective, while I still am positioning our portfolios with the soft landing in mind, we are really focusing more on quality companies with solid balance sheets, solid earnings, solid cash flows, because I don't think it's a complete risk-on environment. I think some caution is still warranted, but so far I think all signs point to a soft landing and the Fed being able to execute this, which is fantastic news.
The other big overarching factor is, of course, the election, which has historically meant uncertainty that's made the market weak in September and October of election years. How should investors handle that volatility?
Yeah, I think investors just need to remember to keep their political views, in the polls, but outside their portfolios. In almost every election year, you see volatility pick up, especially as we get closer to election. And knowing that it's really a toss-up right now, it's a 50-50 shot between Trump and Harris. But overall, I think what you typically see in these election years is the markets don't like uncertainty, and there's certainly uncertainty as far as who's going to take the White House. But once that election is done and uncertainty is removed, that's when you can see the markets rally. So I would just advocate for clients to stay invested, to just block out the noise when at least it comes to their portfolios. And again, corporate earnings are expected to increase by double digits next year. All 11 sectors within the S&P 500 are expected to have positive earnings growth, with 8 out of 11 expected to have double-digit earnings growth. So I would not advise clients to exit equities right now, just to ride this volatility wave for the next 2 months, and then I think we're in good shape from an economic perspective.
Eric Sterner of Apollon, thank you so much for joining us. And that's your Market Insight. Don't forget, you can watch more videos on Reuters.com.